will you agree to calling the leaders of Illinois knuckleheads? Can you agree to that?
Won't do it. He's not going to do it.
Welcome back to Futures Edge Podcast. I'm Jim Urio. As usual, the brains behind the operation, executive producer and co-host Bob Iacchino. And today we have a special guest because when this was just starting out a year ago, before it became a reasonably big deal, Dr. Sr-Kumar of Global Macroeconomist, President Sr-Kumar Global Strategies, was one of our first guests. And we appreciate that very much. Thanks for coming back on. How are you? Everything good?
Everything good, Jimmy and Bobby. Thank you both very much for inviting me back. I thought after once you would have been tired of me, but it looks like you invited me one more time.
Everyone else canceled, so we had to scramble for somebody.
Right.
Not true.
I was the one guy always available.
That is completely untrue. Good to have you. There's a lot to talk about. I want to start out with a couple things because we film on Friday, remember too. So the stock market was relatively buoyant today. And here's what I think, and I want you to comment on this. I think the market is viewing that we're in some sort of calm in a perfect storm, and inflation appears to be coming down. Everything else didn't get too destroyed. Everyone was waiting for something to break. We got a little bit of a crack with the banking crisis, and now people want to believe that that's behind us. Is this a fair assessment of what the market thinks right now?
Jim, you're stealing my thunder. As you know,
Sorry.
I put out my views every week on a Saturday morning, and it's going to come out tomorrow, and I'm giving the finishing touches to it. And the title is going to be exactly what you said. The title is going to be The Calm Between Two Storms, meaning we had a storm with SVB, with Signature Bank, and not this week, which is ending today, but the previous week was a turbulent week. With, again, you had Treasury Secretary Yellen, Fed Chairman Powell saying different things about the banking crisis. And I like to call, in that week, Yellen, I call her Tuesday Yellen, Wednesday Yellen, and Thursday Yellen, because all three Yellens have very different points of view on what they would like to do to protect deposits. Depends on which day Yellen you want to believe. But then all of that was forgotten. Last week was a risk-on week. Equities have done very well. Yields have continued to go down generally over the month. And so it looks like everything is over. But the point here is they are not all over. The crisis is not over because I can't point to one item where the government has resolved the problems, or I get one ray of sunshine saying this is why you have to feel more optimistic. Other than the fact one more week has passed and you can feel thrilled. There were no more bank failures and no more deposit losses during the last 5 days, but that's not enough reason for enthusiasm.
So when we heard Janet Yellen, I think it was Tuesday Yellen, who looked at the congressman in Congress and said, we do not have any plans to protect depositors at banks that we don't consider systemically important. I considered this extremely dangerous. I thought it was putting a seed in people's minds that perhaps they should be rushing out of those banks. When you heard that, did you gasp a little bit as well?
Yeah, it was just a shock to hear the Secretary of Treasury, not just run-of-the-mill analyst on TV who's saying that, but she is the top finance ministry official in the country. And that is what she says. So what is she telling me? Is she telling me to take all the money from smaller regional banks and put it in money center banks? Because I'm going to say tomorrow in my write-up to anticipate it, money center banks will never fail. They can take as much risk as they want because they will not be allowed to fail. Are you telling me that I shouldn't put my money in the small town corner bank LLC? I should move it to the large bank in New York City, Chicago, San Francisco, Los Angeles, so I'll be safe. And why should I put more than $250,000 in a small town bank? I don't get any benefit out of it.
One more question. for me, Bobby, and then I want to get back to you. Do you think when she said that, is there something sinister in that? Does she want just 10 banks to exist, or is she just kind of a knucklehead?
Well, I don't want to use your nomenclature, but let me say
Fair
that
enough.
I will use a more euphemistic term. I think it was highly ill-advised to make those kinds of statement in a public forum in front of the Senate and again the House. And so she realized that Tuesday, Wednesday, after she had suggested that she would not protect all the deposits, you may recall that Wednesday of that week, there was a big crash in the market between the time Powell spoke at his press conference at 2:30 p.m. Then the market was rallying. Then at the same time, and again, this is something which is a puzzle to me, why would the Treasury Secretary and the Fed Chairman speak at the same time? These are two important individuals. Why wouldn't you space out your presentations? But she did. And be that as it may, she went there and essentially said she was not going to protect it. This is Wednesday, Yellen. And so Thursday, Yellen had to come back and she said she would provide an element of protection. So it's a pretty confusing picture. So if you carry it over to this latest week, you should not have any reason to feel optimistic. But obviously the markets were, which is why I think it's not going to last.
So Sri, thanks again for coming on. I really appreciate it. I want to say two things, my friend, before I ask you my question. Number one, Bobby Aichino's interpretations of Sri's comments is that Yellen is a knucklehead. That is not Sri's interpretation of the comments. My interpretation is that she's a knucklehead. So I'm in agreement with you, Jimmy, which doesn't happen every day. Number two, Sri, I want to give you an opportunity to throw your normal disclaimer out here, because then I'm going to ask you a question that I want people to understand is not trading advice. So go ahead and throw out what you would usually tell people.
Bobby, thank you very much for keeping my interest in mind. I think what Bobby is saying here is, I always mention I'm not an investment advisor. I'm not providing you security advice or investor advice. But what I am is a global macroeconomist who has worked with financial markets now for 40 years. So I bring that experience here to this call with all of you, not just as that I'm being investment advisor. For example, because of that, I can think about what the Fed is going to do, what the interest rates are going to do, but I don't move over from there to tell you what it is you should be doing with your portfolio.
Right. So in the spirit of that, I have a friend who he would consider himself to be semi-retired. And he said, and Jimmy, you actually know who this guy is, but I talk to him almost every day. He's semi-retired because he has enough money to retire in Florida, but not in Manhattan. So we're just going back and forth where he's going to find another job or move down here where I am. Every day that I speak to him in recent weeks, he lists another bank where he went and looked at their call sheets, and they have so much of their hold to maturity assets that are underwater, huge, huge numbers. One of the ones he mentioned to me today was Charles Schwab. Another one he mentioned was US Bank. And then there's obviously the assets that are for sale, which aren't necessarily underwater. So two questions to you. Do you worry about these numbers as well? Do you see them and worry about them? And then the second question is, the Fed's balance sheet has been increasing, right? Is this QE, or is this, as Mike Singleton from Invictus Research calls it, not QE because it's a different function?
Let me take your first question. Both of them are great questions, Bobby. Let me take your first question first. In terms of what is happening with what is happening on the markets, is everything resolved here? And the point you made about many of the banks' portfolios being underwater because of the long-dated securities, SVB, or Silicon Valley Bank, was the first one to come out of the woodwork. And if I may use that analogy, it is as if you are going into the kitchen or the restroom and you find one roach. And you conclude, you come out of it and say, that's the only roach that exists. Everything is clean. I removed that roach. Obviously, there are going to be a lot more roaches. And I think the conditions which make for roaches to thrive in the kitchen or the restroom are also present here in the financial sector, what caused one bank to misjudge maturities was something many other institutions did. And here is my criticism when I come to that topic, talking about the topic, Bobby. Jerome Powell said repeatedly in 2021, inflation is going to be transitory. Make believe that I am the CEO of Silicon Valley Bank. Maybe I'm the chief, a person responsible for investment of the portfolio. What should I do in the interest of my shareholders? I should mismatch maturities. I should take the short-term deposits and buy long-dated debt, and I should make long-dated loans. You know why? The 10-year yield is 1.5% or lower through most of 2021. The chairman of my Federal Reserve has just told me that he expects inflation to be transitory. It's going to go down. So maybe the 10-year yield is going to go down from 1.5% to 1%. And I, by mismatching my maturities, I'm going to look like a hero. That's what I should be doing. So this is the message that came from the Fed, and that was, I think, fundamental to the problems we are running.
That's interesting. Before you go on to answer the next question, Tree, that's interesting to me because that's something that no one has pointed out to me. Jimmy, maybe you've been trying to. Maybe this is why the Fed is much more at fault than I've been willing to say to this point, because first of all, they shouldn't be taking investment advice from the Fed, but they do.
Bingo.
They
Right.
do. Go ahead,
Yeah,
Tree. I'm sorry. I just wanted to point that out because that rings true in my head. So go ahead.
No, that's very true. And again, look at Michael Barr, who is the Fed Vice Chair for Supervision, had 2 days of testimony, first before a Senate committee, then a House committee. And he is in charge of investigation of what went wrong. It is as if I am involved in a traffic accident and I drove my car too fast. Guess who's going to do the investigation? Me. I'm going to investigate the same traffic accident in which I was involved. And you will believe the results to be totally unbiased, would you not? And that's what we are going to come up with. Mr. Barr is going to give his presentation, his conclusions by May 1st, according to Mr. Powell. And he's not going to point the finger at the Federal Reserve because that's not in their interest. And so this is essentially the problem with what they have run. And please remind me what your second question is, please. We talked quite
Jimmy,
a bit.
do you want to follow up to that one and then I'll do the second question again, or did you want to wait?
Oh, so yeah, my question, my follow-up to that question before Bobby's second question is that, so we, Bobby and I still do it. Interest rate derivatives, hedges and futures for banks. And we've brokered a lot of hedges for banks. So my question is, when you say they listen to Jerome Powell, and I understand how some may believe them. I was under the impression that most did not, because as far as prognosticators go, the Federal Reserve tends to be average to slightly below average. And I don't even mean to be bashing them. That's just a fact. Don't many of the banks hedge their risk by calling someone like me or when Bobby used to do that and just buy a 10-year put spread?
You should be doing it. But again, look at it in terms of if you're a follower of the Fed to the extent you did, and you think the Fed has the power to restrict inflation to where it says it is, they can bring it down, they can play with interest rates, they can do what it is. So you and I playing in the market do not have as much power as the Fed chairman does. And if that's the case, here is, if I have to use an option, there is a cost involved for me. I will be boosting my returns even more by being naked rather than have a covered position. And that, I think, is what happened with a number of banks. And when they found out entering 2022 that policy, that expectation did not come true, they said, well, Powell said it's going to come down. Well, let me wait a while rather than sell the portfolio, and then it did not happen. So the loss became bigger and bigger. The other one was a great article in the Wall Street Journal in the last 2 days, which I put out on Twitter. And that says very many banks which had their loans in the so-called trading portfolio where they have to market, move them to the next bucket called hold to maturity. So as soon as you're starting to run a big loss, you take it, move it from one bucket to the other bucket, and you ignore the fact that you have run a lot of losses. The problem with SVB is they did the same thing very many other banks did, but suddenly somebody said, let me try and figure out if the emperor has clothes or not. And once you do that and the tide is running out, you find suddenly SVB had lost, the big losses had to show up. They had to sell some of the securities which were in the so-called up to maturity basket, had to run a loss, deposits fled, and then the rest is history. So you're going to have other institutions which are in the same position. And Bobby talked about banks in Miami, for instance, which with a similar situation. So they're all going to come out into the open. And that's why I think this is a long drawn out problem.
So the second question, Sri, that I had asked you was so if you go back to about March of 2022, Fed balance sheet was about 8.9 trillion. It dropped to about 8.3. And last week we saw a spike of about the same amount the Silicon Valley Bank lost, oddly enough, but we saw a spike back up to about 8.7 on the Fed's balance sheet. Mike Singleton from Invictus Research says this is not QE because it's a completely different function through the FDIC and all that. And they're taking securities on as collateral to loans that are going to be paid back, et cetera. Mike, forgive me if I put that forward incorrectly. But then there's other people like Danielle DiMartino Booth who said, make no mistake, this is QE again. Where do you fall in that?
I fully agree with Danielle in terms of what she said, and I will tell you why. And I guess it would be helpful if Jerome Powell had started out by saying, I am the chairman of the Fed, but I want to remind you that I'm the first chairman since G. William Miller in 1978 not to have had formal economics education. And that, I think, shows in very many of the statements. When you increase the balance sheet of the Fed, it is quantitative easing.
Period.
When you decrease the assets of the Fed, it is quantitative tightening. There is no nuance here. There is no making up regarding it happened for one reason or the other reason. What Powell said was, it is not long-term bond purchases that created the increase in it. It is not a change in Fed policy. It is emergency funding for the commercial banking system we provided that shows up as an increase in assets that we are holding. To me, it doesn't matter what your reasoning is. Recall, going back, again, history is very helpful in the so-called temporary funding explanation that he gave. At the end of 2008, beginning of 2009, the Fed chairman was Ben Bernanke, and he started something which we never knew was the case called quantitative easing, which was a very interesting and a novel experience. And he said, at that time, Milton Friedman would have agreed with me that when the interest rates are so low as we have today, meaning end of 2008, there is nothing that we can do except to increase the money supply, and it acts like a negative interest rate. And no less a person than Anna Jacobsen Schwartz, who is the co-author with Milton Friedman on his epic book on the monetary history of the United States, she came out and said, you are plain wrong. This is not something Milton would have approved of were he looking at your policies today. And that is something I would repeat again. The so-called temporary quantitative easing of 2008 has not been reversed in 2023. And the balance sheet of the Fed on Lehman Day, September 15, 2008, was 800 billion. And as you said, it went to 8.9 or more than 10 times that figure by the beginning of 2022. So this is supposed to be a temporary measure. So I don't buy this temporary emergency funding of banks, and therefore it is not QE. For me, there's no difference between temporary and permanent. they can change at the drop of a hat.
Is it less inflationary, Sri, because it's targeted, or it doesn't matter?
No, it doesn't matter. I think it is still inflationary on that side. However, let me qualify my statement. What the Fed is putting the financial system through is a credit crunch. And a few minutes ago, John Williams, president of the New York Fed, was speaking, and he's often considered the second most important person on the Federal Reserve. And he said there is a credit crunch. We don't know how serious or how long it's going to be. And that's something I have been saying since the banking crisis began. What does that mean? The banks are going to be lending less money, even though they get emergency funding from the Fed. The emergency funding is to shore up their balance sheet, not to enable the smaller banks to make new loans. If you ask for a new loan, you will not get it. And that's a credit crunch, and that is disinflationary. So overall, my expectation is that the inflation rate will go down much more sharply because of the banking crisis. And that in turn will bring bond yields, both the 2-year yield and 10-year yield, down along with it. So yeah, go ahead. Sorry.
No, I want you to put a fine point on that. Then I want to switch the conversation to something I think is very important. But just in a short answer, you think the Fed is done raising rates, or do you think there's one more quarter coming?
I think there is one more increase coming. And the reason for that is because despite today's PCE inflation number being somewhat better than expected, we are still at levels much higher than the Fed's target. So it's not as if the Fed has much credibility left, but they will lose even what they have if they just went into a pause right away. But one more rate hike, then a pause, and I'm saying at least 2 cuts through the end of the year.
The reason Bobby and I both laughed, Bobby know what I was thinking. That is Shree's way of saying knucklehead without saying knucklehead. And you don't have to comment on that.
He'll never say it. He'll never
say it. He's nicer. He's a nicer human being than we are. There's no question about it. We are having. Are you familiar with Vivek Ramaswamy, who's the presidential candidate?
Yep.
Okay, so he has agreed to be on the podcast. There's something that I want to bring to him, but I want some input from you first. He has been very, very vocal about kind of cutting ties with China. Has he not? He has, Bobby, right?
Mm-hmm.
So, though to me, it seems like our relationship with China over the last 30 years has afforded us a certain lifestyle here by using inexpensive labor from there. The change to me might be ugly. So by his pitch, aren't we talking about perhaps taking a sizable step back before we can switch supply chains to India or to Mexico, things like that?
Yes, he is. And even though he's running on the Republican ticket, along with Donald Trump, and then he also has the former governor from South Carolina, we have 3 declared candidates so far. Here, in any case, Vivek Ramaswamy speaks more like a Democrat, more like a Biden administration person. They have our trade advisor, Janet Tai, has made a statement saying that having anything like free trade is going to be harmful to us. So I think putting sanctions on China will indeed cause us to lower our standard of living. That's what you suggested. I think it's going to increase the cost to some extent because the cheaper inputs have to be substituted with more expensive inputs, either in the US or from the rest of the world. And they are all going to be inflationary in the long term coming from there.
So it's interesting. I wonder sometimes if a lower standard of living is such a bad thing. From what I've seen over the last 20 years, as our standard of living has gone up, I'm getting.
That's just a fondness for the 70s and
really
when we had, and it's not, and that's nostalgia because we can't speak for other people because people want a good standard of living. Yeah,
I could drive my broken down Olds Omega out on the street. Nobody could find me. They couldn't call me. They couldn't do anything. Anyway, Shri, to the point about the Fed again. So I have been saying over the last couple of weeks, and I never formally announced this, but when I take a position, I'm open to being wrong about it. And I've been saying for the last couple of weeks that I think Fed bashing is getting very boring, and here's why. From my perspective, when I look at just this one component of the Federal Reserve, and this is where I want you to educate me if you don't mind. The one component of the Federal Reserve where they're charged with stable prices and full employment. And a lot of people have said, and Jimmy's been one of them, that the Fed's going to go too far and break the economy. And my stance has been firmly in so what? In other words, it's very Nuremberg, if you think about it. If somebody says, these are your orders and that's it, don't worry about anything else. Why would the Fed ever look at what's happening with the economy? Now they have to look at the banking system. So I understand that. Where am I wrong in that stance? Because I am open to being wrong about it. And I'd like someone to tell me other than Jimmy, because he's tired of telling me.
Here is what is happening. If the Fed is supposed to have inflation and employment as the two targets, just to give you a comparison, the European Central Bank has only one objective. It's only inflation. Why is it that they did that? Because they say, and I agree with the European position, that you have a conflict when you have two targets and one instrument. This is a fundamental point in logic, that if I have one instrument, I can only achieve one target with it, not two targets, because otherwise I'll be flitting from one target to the other target and not doing well in either case. So that's basically the problem. Second, the Fed, even though it thinks of it as twin mandates, the way the structure works, it cares more about the economy and actually about supporting the stock market, to be very specific, than to worry about inflation. And when there is a conflict between the stock market and inflation, and the example, second half of December 2018, December 19th, 2018 was the chairman's press conference. And he had already increased interest rates several times in 2018. And he said, I'm going to increase interest rates more in 2019. And the stock market cratered between December 19th and New Year's Day. So on January 4th of 2019, completely unexpected, he went to the American Economic Association in Atlanta and he said, we are going to be very careful about increasing interest rates. And he ended up cutting interest rates in 2019 rather than increase like he had said before. One, there is a loss of credibility. You didn't do what you said you would do. Second, you caved as soon as you found that the stock market did not like your policy. Stock market support is not part of your mandate, but you made it out to be. So these are the basic problems that I see with the way Fed policy is conducted. And what I have suggested again and again in my writings, Bobby, is that there should be a structured method of setting interest rates. John Taylor, one of my professors for my PhD and currently a professor at Stanford University and the author of the Taylor Rule, he said that you base it depending on whether economic growth is higher or lower than target, inflation is lower or higher than target. You need a computer, you need to fit that number in, and the computer tells you whether to increase or decrease interest rates, and you do it. Here is the advantage. You don't have all this volatility in the market. You don't have all of these Fed governors and presidents contradicting each other pretty regularly and confusing the markets, which is what they've been doing over the past couple of years. You have stability in policy, and that's what I would like to see happen. But the chances of my getting that, zero, a big fat zero in terms of what the probability of what I want happens to be, but that's what we need to do.
So all three of us are married. You've experienced when you tell your wife something and she doesn't listen, and then someone else tells her and she goes, oh, that's a good idea. That's like me and Jimmy right here, because Jimmy's been telling me for a long time it's the Fed's fault. And I'm like, no, it's not. And now Sri tells me, and I'm like, well, maybe you're right.
It makes sense then, right? So here's my question, though, Sri. Hearing what you're saying, and this, I don't have an answer. Normally, I ask a question and I know exactly what my opinion is because, I'm an opinionated blowhard like always. But if you look at that Fed policy and the Federal Reserve since, let's go back to 1985, 1990, whatever, too. Do you think we would have had better outcomes if we just let the market set rates? To my opinion, the question is, are the Fed's tools just not suited to micromanage an economy like ours.
First, one clarification, and that is, I'm not suggesting market will set the policy interest rate.
No, I know. You were saying something different. I know that fully. I'm just saying if you had to choose of what we had over the last 35 years compared to what it would have been like if we had no Fed and the market set rates, what would have been better outcomes? And keep in mind, the housing bubble, the tech bubble, the unholy relationship between government and Fed where they keep raising taxes and regulations, and then the Fed keeps lowering rates to keep the economy humming. What would have been better?
You would have been a lot better off with the automatic system or without the Fed doing the job. And I'll tell you why. There is, again, a lot of history behind it. The same study that I referred to, Milton Friedman and Anna Jacobson Schwartz, that history showed that monetary policy works with a long and variable lag on inflation and on employment. You don't know what the lag is. Is it going to be 6 months, 12 months, or 18 months? And if you're fighting inflation today and you increase interest rates, it may have an impact 18 months from now when you're actually having a recession and inflation has come down by itself. That's the problem. So what the Fed has achieved, and I say that is Fed is almost like a third part of the mandate. We have to create instability and volatility in the market. That's part of our job. And that's what they've been up to. They make contradictory statements. The market goes up and down. And again, people involved in trading, like you and Bobby, for instance, you can take advantage of that.
We love it. Yeah.
Yeah, you should love it, but it does not make for attracting capital from everybody into the market when you do not allow an element of stability and you don't know what the Fed is going to do next. This is the problem, though. There would be a computer in the Federal Reserve building in Washington, D.C. There won't be any human beings needed. That would take all that information and spew out what the interest rate should be and what the money growth should be coming out of it. But the Washington bureaucracy is going to hate it. They want to be able to come in, increase interest rates, lower interest rates, and show the electorate that they are being very active. So even though a computer-generated policy would be more advantageous, it is not going to be followed given the human tendencies that we do have.
So you're referring directly to a Taylor rule model, am I right?
Yeah, that is what I would suggest. If you have a better rule, you can adopt it, but at least you have a structure. We can anticipate what the Fed is going to do under those circumstances.
So tell me this, I've been arguing in that, I think inflation definitely seems to be coming down. I think it's more of a function of supply chains healing up over the last year and a half, of the federal government easing off giving money directly to people to increase demand. I'm not quite convinced that the Fed's rate hikes have even filtered into the system yet. And you mentioned a second ago that with such blunt tools, with such a lag in efficacy, perhaps we're going into recession at the same time down the road that the rate hikes will increase. Have we felt the Fed rate hikes yet?
We have not felt the full impact of the Fed rate increase in the economy. Good question and a timely question, Jim. But what you have had, and I've been saying this again and again, is that we are going to have a credit event. And that happened with the Silicon Valley Bank and Signature Bank. That's the first of the credit event. Now I'm convinced that since they did nothing about correcting it, we are going to have at least one more credit event. And what is a credit event? It can take different forms. It started with the banking crisis in the case of the United States. Take the case of the United Kingdom. In September of last year, we had a short-lived prime minister and her chancellor of the exchequer who unbelievably cut taxes. At the same time, the Bank of England was increasing interest rates to control inflation. This is like saying, I'm trying to take the water out of a tank and you come in and take a hose and pour more water into that same tank, and the two of us are working against each other's interests. What did that do? It cost the gilt, as they call the sovereign bonds in the UK. The gilt yields shot up. The UK pension funds had massive losses. And the Bank of England overnight switched over from quantitative tightening to quantitative easing. Forget about inflation.
So just to put a fine point on that real quick before Bobby, is that when that happened, Larry Kudlow and I got into this argument because I was on his show on Saturday, and I said this was not the right time to cut taxes. And you guys froze up. Am I froze up?
You're frozen, but we're not. He froze. There you are. You're back. Go ahead.
Oh no, I was going to say, the only thing I was going to say is that Larry Kudlow and I had an argument about Liz Truss's rate tax cuts, because I've never met a tax cut that I don't think is the right thing to do, except for that tax cut. It was just at the wrong timing. And he was like, "You're crazy. She's like, she's doing all the right things." I was like, "No, I don't think so."
I agree with you, Jim. That kind of ideological fervor without understanding the circumstances UK was going through was what led to that crisis. And we are still not out of it, by the way, because interest rates in the United Kingdom are higher than they were before September. And there, very many of their mortgages are much shorter term than in the United States. So they are going to come up for renewal very quickly, and homeowners are going to find that their interest costs are going to just shoot up, and that's going to cause a secondary problem for them. So that is their credit event that came to the UK. What else can come here in the United States? And this is something I worry about. We have all of the public pension funds, which are very many of them have not had a good record in 2022 in terms of how much they have to pay out in actuarial benefits to their beneficiaries, to their employees, compared with what they earned. Typically, they have to get 7 or 8% positive every year, and they ended up getting a negative return. So if you have that happening repeatedly, and again, your state is one of those which has a perennial fiscal problem, and what you're going to have is the pension funds going over to the governors of the states and saying, we need for you to give us money from tax revenue so we can pay the benefit. Who's going to finally pay the taxes? The taxpayers. So you're going to, at some point, that is going to interfere with monetary policy, and that is my fear as to where else the storm threat could come from.
Before Bobby's question, real quick, will you agree to calling the leaders of Illinois knuckleheads? Can you agree to that?
Won't do it. He's not going to do it.
I leave the term to you, Jim, but I basically think that there is a problem at hand. We haven't got over that yet. Bobby, you were going to say something.
Yeah, it's been one of the joys of moving to Florida 3 years ago, is just kind of looking around and saying, wow, pensions are funded. And I mean, it doesn't apply to me, so I don't even know why I care. But at the end of the day, I wanted to ask you where you come in on modern monetary theory, because obviously I'm not a fan. And I had an argument with a friend down here, a close friend. We're still friends because friends should be able to discuss things. Jim and I have been friends for almost 30 years, and we haven't agreed on a damn thing in those 30 years. But modern monetary theory, I maintain its biggest problem is it's going to be run by people in government, in theory, other than, I mean, outside of what I see as the normal problems. Where do you come in on MMT?
Now, may I use an epithet, right?
Yes.
Which I did not do before. I have only one word, Bobby, to describe MMT. I would call it garbage.
That's as mean as he'll get.
Victory.
Sorry?
I said, that's a victory.
That was a blistering comment.
It just doesn't mean anything to say that I am a key currency issuing country, namely the United States, and therefore I can do whatever I please on the fiscal policy because I have the ability to print money. And we have a country called Great Britain, which at the turn of the 19th century, getting into the 20th century, was the leading economy of the world. The United States was nowhere close to the British dominance of the global system. The pound sterling was the top currency in the world, but they lost it. After 2 world wars, a huge expenditure, and being unable to defend themselves without the US coming to the help, the UK was no longer the dominant power, and you don't think about the pound sterling as a key currency anymore today. What it means is that the dollar can eventually lose the dominance. And if you practice MMT, you're going to cause the demise much faster than otherwise.
Can you elaborate on that too? Because I tweeted something out yesterday, is that in the United States, we don't have to have a great currency. We don't even have to have a meh currency. All we have to have is a better currency than everyone else. And we still do, because those currencies are run by profligate spenders as well. You say we are in danger of losing reserve currency status. That's a longer term viewpoint you're talking about, correct?
I'm saying this is conditional. You would lose the key currency status if you followed MMT to the extreme. We haven't followed it. At least there is some element of discipline still remaining, number one. And second, I agree with your point. You just need to be better than the others. It's like saying, you and I are being pursued by a bear. How fast do I have to run? I just have to run a bit faster than you. I don't need to be a fast runner.
It's one of my
I could
favorites.
fight a bear, so I'm not worried.
So that's what we are going through right now. You have a situation when the other countries are not, there's no other country competing. China is not. 5 years ago, they said the renminbi yuan would be a competitor. But we have had capital controls, the Chinese government coming down on private enterprise. So the question is, if you put money, if you hold renminbi as your currency, you do not know if anything will happen to it, if you'll be able to transact it. Given, let's admit it, the US dollar and the US currency has suffered a decline, because when you put a freeze on Russian deposits and oligarchs' deposits in the United States, you may do it for geopolitical reasons, but it still weakens the dollar's long-term status. But as you said, Jim, it doesn't mean that you change it overnight, but it is just something to watch out for. You have to balance your geopolitical interests with all what we economists call a seigniorage, or the benefit that you get from giving your piece of paper to the foreign countries and getting goods and services in return. If you lose that privilege, that's going to be a pretty serious loss.
So 2 quick questions from me. And number one, do you see, I mean, obviously our fiscal policy is a mess. Our monetary policy is a mess. The banking system's under stress. Is there an economy you see that you believe at this point in time is managing their own situation better? And then the second question is, where do you fall on central bank digital currencies?
Is there a currency that
just a country that's managing its own situation better?
Is there a country that does it better? I would say on the whole, very many of the emerging markets which have had crises in the past related to debt, related to high inflation, are in better shape today than the developed countries are. And I would point in particular to Mexico, Brazil, which increased interest rates sharply and early. Very many of the Asian countries are in better shape because they have younger populations, and therefore they have a more productive economies. So on the whole, who is doing that better? I think many of the countries, not in the developed world, but developing countries, which is a switch. Usually the developing countries used to have crises and the developed countries had to bail them out. Now, it reminds me of a trip I made to Brazil to talk to government officials in the beginning of 2009, after the 2008 crisis. And they laughed at us, Americans visiting them. And they said, you used to say things were difficult with us, but we learned from past crises. So right now, at the beginning of 2009, we don't have any financial crisis like the United States because we are in much better shape because of the discipline. And I did, an interview of the central bank president in Brazil for the Milken Institute conference. And he came out and he speaks as if he's in the University of Chicago classroom, economics department classroom, in terms of how he speaks and how he's dealing with it. So I think very many of those countries are better. Going to digital currencies, I would like some way for the central banks to have control over the currencies. And this is a very old-fashioned and unfashionable view that I'm going to give you. And that is that when you have cryptocurrencies, and I didn't believe in a crypto either because I want to see it, I want to touch it, I want to feel it. It doesn't mean I think the Federal Reserve is the best managed central bank in the world. It is not. But what it is I can see the central bank, I can see the dollars that they create, and we know where ultimately the obligation for the dollar goes back to the central bank of the country. So to the extent the digital currencies do not have that similar structure, I would probably be reluctant to accept them for use wholesale.
Here's a question. So this was posed by Jim Lewis of Wall Street Silver on Twitter today. He took a poll and said, let's say your entire worth, your net worth, you have to tie it up in one instrument for the next 10 years. Let's say 10 years. He said 20, I think. The dollar, gold, Bitcoin, or a basket of other world currencies 10 years from now, and you have to put your money into something.
Dollar, Bitcoin, other currencies, and only thing which is not a currency is gold.
Right.
Yeah. I'm not allowed to split, right? 100% I have to.
You're not allowed to split. It's got to be 100%. Yeah.
Yeah. I think if you had given me the percentages, I would give you a different answer. But since you make me put all of it in one area for the next 10 years, I'll still be in dollars.
Okay. Now, I like your percentages answer, though. Go with that too.
If you gave me the option of choosing two places I can put my money to in the four areas you mentioned, I would probably put 75% in dollars, 25% in gold. Putting it in gold would be my backstop. It would be my fallback safety mechanism.
I would do 100% gold, even if you gave me options personally from that perspective, because I just don't have the confidence. It seems to me to be the only thing that's not managed by people. Now, granted, the value of the gold can change depending on the management of other people, the different assets, of interest rates, et cetera. But if you're telling me I need to put all my money in one place for that amount of time and I can't move it, I'm going to guess that something's going to go wrong in that period of time where I'm going to wish I was in gold. So I would literally put it all in gold. And gold was, Jimmy, you know this, gold was my trade for the year this year, Sri.
It's working great.
You've done very well.
It's been my trade all year. In November, I was asked to do a looking ahead TV interview, and they said, what do you like for next year? And I said, gold, for different reasons than it's actually performed, to be honest. I thought, and this could lead to a question, and Jimmy, if you don't mind, I'm leading. I mean, I am 100% in a recession camp personally. And when I look at gold can rise during inflation, but not when the Fed is fighting inflation. In other words, interest rates are rising, gold declines. Gold can go up during the beginning stages of inflation because it's an asset, and inflation in the beginning stages tends to bump up asset prices like housing and stocks and gold. And when I look ahead, I can see one of two outcomes. I can see either we have inflation higher than 2%, or we're in a deep recession, and probably both. So that was the reason I like gold. It wasn't because of bank stresses. I think my particular gold position got a little bit of help because of SVB and Signature and things like that. So am I crazy to think that going forward?
No, but gold would be an effective competitor to the dollar, which is why I asked Jim for the ability to give you two options rather than simply take one. Gold would be a close second for me to the dollar in terms of where I would want to put it. Mm-hmm. The shortcomings of gold are that its value is also dependent on how much is produced every year. How much comes from South Africa in terms of production, for instance, is a big determinant of the price, and how much comes out of private hoards. China, India, and France are the three big private hoards of gold that's available. And if in an Indian marriage market is over and they sell gold in the market, the gold price will go down worldwide. So those are the types of things that you can't normally predict, which affect in the short term. Long term, it might do well, indeed. I don't expect if you give a $2,000 base, I don't think it is going to go down below that 10 years from now. But the question is, with your dollar cash and assuming you're able to invest it profitably with that 100% put in dollars, can you beat the return that you're going to get from gold? And that's where I think I'm in somewhat two different minds as to whether I would go with your camp, Bobby, or stay with where I'm saying with putting a good chunk in dollars themselves.
Jimmy,
So
where are you
before
on that?
I don't know. I think the dollars, that's how I answered the survey. I said the dollar, so I'm with Sri.
Yeah.
But I'm glad as hell that I don't have to make that choice because, as you know, I have gold, I have copper, I have silver, and that's been kind of my big push for this year too. But I noticed both you guys, like every time I've kind of thrown out Bitcoin, and both you guys completely gloss over it. You guys have zero confidence, zero faith. Sri, start with you. Bitcoin means nothing to you.
It doesn't mean anything to me. And again, for example, I watched John Paulson speak about his things, that the crypto is something you just don't believe what it is, that it is going to be. My children have told me that I'm old-fashioned, that I don't understand the modern changes that are taking place. But I basically want to be sure that the currency is there and it doesn't disappear at the whim of a few individuals. I'm told that they are done by computer algorithms, so clearly crypto is going to exist and to do well. But if I do not understand the basis of it and how it works, I can't also make investments in it. That's where I come from. I'm not saying you are wrong if you believe in it, but my knowledge and my experience tell me to stay away from it.
Yeah, I mean, we need to have a crypto guy on here because one of the things, I was on WGM radio in Chicago before I left. And I don't remember the guy's name, the afternoon show guy. Anyway, he was asking me to explain why I was, they called me a fan of Bitcoin. I do own some Bitcoin.
Same.
I bought some around, we've talked about this. So I sold all of my Bitcoin last March, and then I bought in again recently. At about 19,500. So the Bitcoin argument to me that a lot of people made that didn't quite understand it, and I lump myself into that group of people who don't fully understand it, was that it's going to be a favorite tool of criminals. Well, that's not good enough because that's all cash is right now.
Right.
Cash is a favorite tool of criminals. So that's not a good argument. But what I don't get is, and we need to have a crypto guy on at some point to explain to me, and Sri, maybe why can't cryptocurrencies just be legislated away? I mean, why can't governments collude and say, this is not legal tender and you can't exchange it?
And why haven't they by now anyway?
Agreed. I think they're waiting for their own central bank digital currency to give people an option personally, but that's the conspiracy theory in me. So why can't it just be legislated away? And the proponents of these coins, Sri, maybe you can ask your children, the proponents of these things say, well, we'll still use it. But yeah, I mean, if Jim and I decide, Jimmy owns a restaurant in the suburbs of Chicago, Sri, and I could say, hey, Jimmy, if I send you a Bitcoin, will you give me a burger? And he might say, well, not one Bitcoin, but he might say yes to that. But if he can't eventually go to the grocery store and buy groceries for his family, what good is it?
Right. Right. No, in Bitcoin, in order to be valuable, should have the characteristics of money. We say, and the basic monetary theory, it should be a store of value. It should be a medium of exchange. That means that once I receive it, I should be able to give it to you and get something of value from you in exchange for the Bitcoin. But in order to do that, there needs to be widespread acceptability. And that means all of us believe in the Bitcoin. You think you're going to get paid. And if you have more people like me running around in society, then it doesn't thrive because we don't accept it.
Right. Okay. That's a great way to end it, I think, too. We don't want to keep you all day. For people who are watching, too, I want you guys to notice something, that Sri is such a good guy that he can make Bobby and I behave. We haven't sworn. We haven't said anything that terrible. The worst thing I've ever said was Knucklehead, which is very unusual for this podcast. And that's because of respect for Sri. Thank you so much for being on. It's been a lot of fun.
Thank you very much for inviting me.
Sri, you're very kind to be here again. Thanks again, my friend.
You're very welcome. Good to be with you. And again, have a good afternoon and a good weekend.
Cheers.
You too,
We'll
brother.
see you, Sri.